We start with the highly anticipated economic news out of the U.S. The Federal Reserve has decided to keep its benchmark interest rate unchanged at near zero, citing slow inflation growth. Our Kwon Soa starts us off.
The speculation is over, for now at least. The U.S. Central Bank froze its key interest rate Thursday following a two-day policy meeting with only 1 out of 10 committee members opposing the move. This despite the U.S. economy on a recovery track through robust spending and declining unemployment. Fed chairwoman Janet Yellen said she expects the U.S. economy to continue to perform well, but that recent global market volatility and other factors are delaying what would be the first rate hike in a decade.
Inflation, however, has continued to run below our longer-run objective, partly reflecting declines in energy and import prices.
Yellen said a rate liftoff will come when there is more confidence of inflation rising to 2%, the previous target of the central bank. U.S. inflation currently stands at around 1.2%. Analysts say the U.S. also had to consider effects on developing countries, as a hike would have crushed the purchasing power of developing nations.
If we have the emerging markets starting to struggle and we're not able to export goods and we're not able to create some sort of global inflation by a growing economy around it, that's going to be trouble for the U.S. economy as well.
Korea, one of those emerging countries, had its concerns too, with foreign investors recently pulling out of Korean stocks.
The delay could provide some relief for the market. If the interest rate increases, it will happen gradually. So I don't think Korea will be affected that much.
Korea's vice finance minister said uncertainties will continue for the time being, and Korea's central bank chief said there could be a chance of a hike in October or December, which raises questions whether Korea will also raise its key interest rate this year. Kwon Soa, Arirang News.